Hey, welcome to Mr. Market. Thank you so much for joining me. We're now to episode 22. This past week, the market was up strongly. It was up 1.7%, pretty much on the news that there was an expectation that we could get a deal on the debt ceiling negotiations. There was a statement from congressional leaders that there was a path forward and they saw a potential deal coming this week. As for us, our strategy is a lot like standing on an escalator, where we go up fairly steadily and we don't go down as much as the market, but when the markets do jump strongly, we don't participate as much. So for the week, we were up $1,487, and that puts us year to date up $31,467, which is about 63% of our annual goal of 20% a year. Again, our target is to earn $50,000 a year off a $250,000 portfolio. For this week, part of our profits not only came from selling our puts on the S&P 500 ETF, but we also made some money playing the earnings reports for Target and Walmart. And we did that by selling a combination of calls and puts called a strangle. And so once the company provided their earnings reports, as long as the stocks stayed within our upper and lower boundaries, we made money. And that's what happened. Our calls on SPY up at $420 did not make us money this past week because the market had such a strong week. It temporarily breached those levels. And when it went above 420, I rolled them up to the $421 strike price. And when we did that, that pretty much eliminated our profits. You know, you can't win them all. And in this situation, when the market's really strong, I don't want to be fighting that trend. So this was a case of trying to be a good loser and taking the loss and moving away from the market so we don't have any potentially larger losses. This is a situation that I like to say, you're going to be experiencing either the pain of regret or the pain of discipline. And whenever I'm faced with those two, I'm always going to be choosing the pain of discipline. And remember, the key to being a great trader is to be a good loser. Okay, let's talk about the market and let's look at some charts, because there's a lot of things that can be considered really bullish, but on the other hand, there's also a lot of other factors that can be considered very bearish, and I wanted you to be able to see the same things I'm seeing. First, let's look at that big picture. We can see here that the market was trapped in a wedge for quite a few months, and then last week it broke out decisively to the upside. Now that's a bullish signal. And you know what else is bullish? Whenever the Fed has finished increasing their interest rates, the market has tended to go up pretty significantly over the next 6 months. And for the contrarians out there, whenever we've seen an excessive level of pessimism, that has tended to be a good sign for markets, because that means there's a lot of money on the sidelines. And once things become a little bit more bullish, once the coast is clear and things become a little bit more safer, all that money that's on the sidelines tends to come back into the market and push markets higher. And we can see here that the market is, at one of those levels where we have an extreme level of pessimism that's lined up with other levels in the past, other time periods in the past that have coincided with dips and lows in the market. So that's one, positive consideration for the market going forward. Once we get past this debt ceiling issue, once we get past the fears of how bad this recession can get, there's a lot of money on the sidelines that's waiting to bring the market back up higher. Also, we have insiders that have been buying. There's a chart here that shows the number of buyers has exceeded the number of sellers. And typically, they've had a pretty good track record for when to go buy stocks. Also, this long expected recession is expected to be pretty mild. And after a couple quarters of weakness, the expectation is that we'll go back to healthier levels of growth. And that can be positive for the market. But a lot of it will depend on how the debt negotiations turn out this week. And as you can see, the Treasury is quickly running out of money. But if you look at this chart, you can see that there's generally a pretty high expectation that we're going to get a deal done. Now, here's the bearish part. If there's one thing that can keep the market down, it's the Federal Reserve, especially if they think that interest rates still need to go higher. Because right now, the market's priced in no interest rate increases. In fact, they've priced in interest rate cuts. So every single time that the Fed does not cut rates, that's actually considered a pretty bearish development, because it's going to mean that interest rates will be higher than what is currently being priced into the market. And so far, there's a creeping fear that the Fed isn't done raising rates, because we've had a number of Fed officials coming out and saying that inflation hasn't come down quite enough yet, and it has been pretty stubborn. And in fact, the inflation expectations have been rising. So that's going to be a problem for the Fed, and they're going to need to adjust that by possibly raising interest rates. Also, what's been driving the market has just been a handful of stocks. Only 5 stocks have made up 80% of the returns year to date for the market, and the top 6 have made up 92% of the S&P 500's returns. So if you take them out, the other 494 stocks would leave you with very disappointing returns. It's also why it's so important to have exposure to the indexes so you don't miss the biggest names that are driving the returns. Also, if you look at the equal-weighted S&P 500 index, now that one shrinks the effects that the largest stocks have on the index. And if we look at it from this perspective, we actually have a very bearish signal called the death cross happening. I know that's a pretty scary sounding name, but that's when the 50-day average crosses below the 200-day average. And from that standpoint, it's actually the opposite signal that we were given when we looked at the market breaking out above the wedge. Also, relative to the S&P 500 index, tech stocks are now higher than they were back at the 2000.com bubble. And when you look at something called the advanced decline line and compare it to the NASDAQ, there's a huge divergence that shows the majority of stocks are falling, but the index is rising. Now, this is not a sign of a healthy market. So that's why we have such a confusing market. On one hand, we have a lot of charts and historical precedents that shows that we can have the market continue to go higher. But also, if you take a look a little bit deeper into the numbers, there's quite a few bearish factors out there. This market is not as strong as it seems, and it's only being driven by a handful of stocks. But for the rest of the market, it's actually quite weak. And again, a lot of what the market will do this coming week is going to depend a lot on the debt ceiling negotiations. If we get a deal, as many expect, we can get that short-term pop. But, this could be one of those situations where the market buys on the rumor of a good deal happening and then selling on the news once that actually comes out. And so I'm expecting, some kind of initial pop followed by a little bit of a sell-off and let the markets kind of consolidate their gains. And then they'll have to start thinking about, how deep can this recession go? And then once the markets can absorb that, then the market can continue to start moving higher. But if we don't get a deal, all bets are off, and that'll probably crater the market, and no one is going to be very happy about it. So we're going to have a pretty binary event, and I think it makes a lot of sense to be a little bit cautious. So for this week on my portfolio, I have sold some puts on the S&P 500 ETF with levels as high as $410, and then $405, $403, and $400. And I also have some puts that I sold on the bank ETF KRE at the $35 strike price. And I also have a strangle on Costco, since they're going to be reporting earnings this week. I have some puts that I sold at the $460 strike price and some calls that I sold at the $530 strike price. As long as Costco stock stays within those boundaries after earnings, I'll be able to go profit. So I'll be watching that carefully this coming week. And the algo is still bullish. It ended up being the right call for the past week, even though I had my doubts. And one thing that I realized about it is that the algo is basically telling us what Laden thinks. It is giving us the most likely probability that the market is expecting. And that's why the algo has been so successful and why our trading strategy has been so successful. We are continually adjusting and adapting to what the market is expecting. And the algo is keeping us in line with that. That's all I've got for this week. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you'll know when my next video drops. Again, you can find me on my new domains, mistermarket.us or mistermarket.us. So thanks again for joining me. Hope you have a good week trading. Good luck, and I will see you next week.